Hello again, and welcome to the Just Don't Lose the Money podcast with Sam Lang at Rubino and Liang Wealth Partners. My name is Randy Cook, and we're here each week to sit down and talk to you about some of the things that you might be up against when it comes to planning for retirement. After all, Sam, you've been helping people for over 30 years doing just that, and we had a radio show for a very long time, and now people can look at our smiling faces in your beautiful suits here.
There's a reason why we had a face for radio for so long, right?
But, it's all about the information, and that's what we want to make sure people have.
Yeah.
And when people come into retirement, you tell me all the time, people have been good savers. Where have they saved their money? Usually it's a 401k. And there's a big question here. What do we do with this 401k once we get into retirement? It's a place to put money. Then what?
Exactly. Then what? It's a huge question because I think in today's world, you're seeing more and more people, maybe companies getting downsized, or hopefully you're not working for the government. But if you are, maybe you got that slip that says you're not coming back to work tomorrow, or at least gave you a choice. And all of a sudden now you have this 401k, which in our practice, we probably see, I don't know, 80 to 90% of a client's net worth is in their 401k plans, because that's how we've been sort of trained and taught to save, have that deducted from your paycheck every other week. And, that's your nest egg for retirement. So at that stage, you have to make some really important decisions. And I thought what we would do, Randy, is focus this show on when you do reach that point, you have this 401k with a decent sized number, and the do's and don'ts of what your choices are, and how not to make sure you don't make any mistakes so you don't lose any money doing it.
There you go. So let's talk about this a little bit. I mean, the first thing is I've been packing that money in there forever. Why not just leave it in there and use it as I need it? There's ups and downs to all that, isn't there?
Sure. There's pros and cons to every decision you make, and leaving it alone in your former employer's plan, well, that's probably the easiest thing to do. You're probably used to the website. You've been going on it, every other day for 10 years, tracking your investments. You know how to take a loan out. The investment choices you need to reallocate, so you're familiar with that. And that's probably the easiest thing to do. And there's nothing wrong with doing that, because you've probably had that plan for many years now. But now you have some choices, right? So maybe in those years that you've had it at that point, that current employer's plan, maybe the choices are limited. You might say, hey, you know what? I see interest rates going up. My local bank is offering a 5-year CD at 5.2%. Well, that doesn't exist in your 401k plan. So you have some downsides in terms of by leaving it there. The fees might be higher than they should be. So maybe you've been paying, maybe there's elsewhere that you can go and pay lower fees. One of the things that you might be shut out on is if you've had any 401k loans while you're employed. Now you're no longer an employee, so you might not have that loan privilege any longer. And then we've also found that they treat current employees and former employees a little bit differently, even though it might be in the same plan. You might say, hey, you know what? I'd like to take out $500 a month. Well, as an employee, maybe you can take out money, but as a former employee, they might say, well, the only way you can take anything out is you're going to take all of it or none of it. So your choices in terms of how you can access your money might be limited. But yeah, that's the easiest thing to do, which is to do nothing and just leave it there.
So then as we move on, then now we talk about this all the time, is taking that money into your control, rolling the money out and putting it into your own personal IRA, your own account. And now there's a lot of steps involved here, and this is where the tripwires are, because there's a lot of rules involved with this, aren't there?
There is. It's probably the most common choice. People understand that, and they might have had their own 401k plan, their own IRA. Maybe they had a former employer that they rolled over that 401k. It might have been a small one, but now they have a self-directed IRA. Maybe they're working with an advisor that's helping them with that IRA. So really, at the end of the day, if you roll it over to an IRA, which is your own individual retirement account, the world is your oyster, as they say, right? You have plenty of choices. You can do anything you want. You can go to the local bank and say, hey, you know what? I actually want that 5.2% 5-year CD. And you can do that, whereas you couldn't have done that by leaving it in your former 401k. You have investment choices. You have a lot more. Maybe you can find choices that have very low fees where you weren't able to in previously in that 401k. But there's really the right way and the wrong way of doing. The right way is what we call a direct rollover. So that the money that you have at ABC Corp 401k goes to your IRA. It might be at Fidelity, it might be at Vanguard, but you actually don't touch that money.
Okay.
Sometimes people are not specific about that, and they'll end up doing what is called an indirect rollover. So you get the check payable to, in my case, Sam Lang, and then I turn around and I put it in the IRA that I already have set up at Fidelity. The problem there is they mandate withholding taxes 20%. So you're not getting all of your money at once, even though you might not owe any taxes. But with an indirect rollover, also you have a 60-day rule, Randy, which means that you have to be precise, track that, make sure the time from the time it leaves your former employer to your current IRA, it does not exceed 60 days. If it does, guess what? You have to deal with Uncle Sam. Penalties, taxes. There's a laundry list of things that you don't want to have happen if you sort of goof that part up. So you want to be precise in terms of how you do it.
Just put that right on top of your income for that year, and all of a sudden you get a huge tax bill, and you didn't intend on that.
Yeah. I mean, can you imagine making a mistake on a $7-figure, $1 million 401k rollover, right? Now you got to pay taxes as if you made $1 million that year. So
Yikes.
Yes, no fooling, and you definitely don't want to do that. But that's a very common way of really sort of killing a bunch of birds with one stone. One, maybe better investment choices, broader investment choices. Two, it allows you to maybe add money in the future, whereas if you left it at your former employer's 401k, that choice is gone. You can't add money to that. Maybe lowering fees. Hopefully you're working with somebody that can really help guide you so you have a nice diverse asset allocation. But there's probably more pros than cons in making that election.
And one of the things that we find with people who get into this stage of life is there are some great accounts there for you to pull from. And sometimes it gets a little tempting and people will actually cash out their 401k. And that leads to a lot of problems, too. So that's
certainly a choice.
There's your tax liability. Yeah.
Yeah, you can cash out. That's another choice that you can have, which is to say, hey, you know what, just give me my money. I've heard people say to me, and even some clients call, hey, I just left such a so-and-so. I'm leaving at the end of the month, and I'm just going to cash out my 401k. They don't really actually mean that. They mean they want access to that. But sometimes if you actually ask for that by accident, they're going to send you a check, and that's all taxable income. Now, if it's a small 401k, like my son, who's 26 years old, he was at a great job, but for about 10 months, the company actually wasn't doing well and is unfortunately folding. So he has a small 401k. Now, if he cashed it out, it's probably not the end of the world because, maybe $1,800 in it. But if it's $180,000 or $1.8 million, you don't want to cash it out. You have severe tax consequences if you do that.
So one of the other things about 401ks in some models are you put money in and you have to stay in there for a certain period of time and you get what's called vested. And so that means that the company will make that money completely available to you after a period of time. What if you're kind of in that window there, Sam? That could bring up some problems.
Yeah, you just want to make sure you understand the vesting schedule. Like here at Rubino Liang Wealth Partners, we have also a profit sharing component to our 401k. So if you work for me, you put in $1, we actually match you 100% for the first 3% of that match. Mm-hmm. But guess what? Well, there's a vesting schedule. It doesn't say, hey, I'm going to give you money and you can leave me 6 months from now and take all of it. So there's a 5-year vesting schedule. Okay. You just want to make sure that you understand that. And if you're going to leave something on the table, you just want to be aware of that. So yeah, vesting schedule will come into play on those rollovers.
So it seems like such a simple thing to do, but you've identified a number of things that can get you into trouble. Would you recommend people can do this on their own, or they should seek professional advice? They should sit down with you and really find out what's right for them?
I mean, people can certainly do this on their own, but at the end of the day, like you said, there's pros and cons to every decision that you make. you just want to make sure you're making the right decisions. I think where we find that people seek out advice and we can bring some value to their situation is, I think for the longest time as people are working, they're really in that accumulation mentality. How do I stock away the money? How do I make it grow as quickly as possible? How do I get it to be a larger and larger number? And that's great. That's what we're supposed to be doing. But as you're nearing that retirement journey where you're going to actually stop working, not only is making money important, but keeping what you have, or following the name of our show, just don't lose the money. Mm-hmm. So we want to make sure that we have that component in place, understand the downfalls and the setbacks of when you have a negative year, especially if you're taking out withdrawals. But I think one of the biggest things that we see that people have not done is really pay attention to what they own. With target date funds being as popular as they are, we've seen people come to us that might have had a target date fund of 2020. And here we are in 2025, 2026, okay, and they still have something that's really not working to their best ability. So I think getting advice from a financial professional, whether it's your CPA, whether it's an investment advisor, whether it's a retirement planner, I think it's in your best interest to not only do the rollover portion, the admin part correctly so you're not taxed on it, but to get some good advice so you get a good sounding board, as well as continuing to grow your money, as well as now protecting the money is probably equally as important.
One of the things I think that is important about what you and I do here is to give people examples of don't let this happen to you. And I got one story for you here. I mean, that money, when you get up, $500,000, $700,000, $1 million in a 401k, and you get to retirement and you see that beach house and you go, well, there's the money. I heard a story just like that. Lady had $500,000 in her 401k, found a $300,000 beach house, decided that's where it's going to come from because that's my biggest account. She grabbed it. She spent $300,000 and the next year got a tax bill for $75,000.
Right.
Because, that just gets added right onto your income. And then she didn't have any place to get the 75. So what did she do? She went right back into the 401k and the same thing happened again.
And the next thing you know, that $500,000 401k is no longer. It's gone.
It's gone. Exactly.
Yeah. We have that.
Got to avoid this.
And at least have somebody to talk to give you some sound advice as to, hey, it's a great move, or let's pump the brakes a little bit. Probably not a good idea. Let me walk you through why that's not a good idea. From time to time, we have that same exact issue. People get excited. Hey, I've always wanted that lake house up north. They start looking. They think they can afford it, and they probably can, but maybe not all of the money is coming out of the 401k. Maybe they have some other savings that they can tap into. But that's why working with a financial professional, I think, is really important.
It's so common to have your biggest financial asset in retirement is your 401k. We want to make sure we're handling that correctly, not making mistakes. Sam, on our website, justdon'tlosethemoney.com, up in the upper right-hand corner, it says Start Here. People can click that button. If you're in that situation where most of your money's in that 401k, you don't want to make a mistake like this, tell me what happens when people go to our website.
Yeah, it's very simple. So, and justdon'tlosethemoney.com is actually a calculator, an exercise that you can walk yourself through. It's called a PIN, your portfolio income needs, and it will help you sort of determine, oh, listen, this is, I got cash flow, I'm working, that's great, but when I stop working, there goes that paycheck. Now I have Social Security, you might have some rental income, maybe you're lucky enough to have a pension, but we're going to help you match that up against what you spend. And if there's a shortfall, you're going to actually be able to determine what that shortfall is, and then go through an exercise to see what you've saved is going to be enough to last you. Is it 5 years? Is it 15 years? Or is it your lifetime? I think that's a really important exercise to go through. But you can always click on the tab that basically asks for a 15-minute strategy call, which will give you the ability to have a conversation with myself or one of my partners and just have a conversation about, hey, this is where you are. You got some questions. We're here to answer them for you. Sometimes people are looking for additional help, and we can offer that as well.
Well, it's so important that as you get toward retirement, you've done a great job saving. You see those numbers in your accounts. And what Sam says, just don't lose the money. So let's sit down and get some good advice on your 401k and all the issues that go with retirement. Give us a look on our website, justdon'tlosethemoney.com. I want to thank you so much for watching, and we'll be here again next time on Just Don't Lose the Money.
Have a great day.